Hi, my name is Dominic Tamaro, and I'm the Vice Chair for Education at the Warren Alpert Medical School at Brown University. For over 30 years, I was the Internal Medicine Residency Director, and for many years, residents would come in and ask me for financial advice, and that really was the genesis of why we put this curriculum together.
Hi, my name is Pete Heckman. I'm a financial planner for physicians and have been for 20 years. I'm also the founder and managing partner of Residency to Retirement Wealth, which is a full-service planning firm for medical professionals.
My name is Chris Weber. I'm also one of the founders, managing partners for Archair Wealth or Residency Retirement Wealth. I've been a financial advisor working with physicians for about 20 years, and we are part of the GSI program that's here. We're the endorsed advisors for the GSI plan at Brown, and I live in New York, but we're here quite often.
Thank you for visiting this financial literacy curriculum that we've developed here at Brown. Today's session is going to focus on something that is really important, but it's probably something that a lot of folks don't think about early enough, and that's disability insurance. Insurance, in my view, I look at it as paying someone else, in most cases a company, to share or shift some of the risk of something bad happening. And I think that's something that we're going to focus on in greater depth to help everyone understand it and to understand what role it might play in safeguarding your personal and professional lives. So I have some experts here with me, and we'll get started. If you guys can maybe explain what exactly is disability insurance?
Yeah, I think disability insurance, before we even think about like what it is, for a lot of people, it's just, is there a need for it? So people a lot of times hear about disability insurance, and I think they know it's there in case I get sick or injured. And I think for a lot of them, people think, well, sick or injured, that makes sense. But what is the actual need? Do I really need this? Do I really need to be buying this? People are telling me to buy it, but like, do I actually need it? And I think the conversation is, you're now done with medical school, you're earning an income. It's really important. You're seeing patients, you're making money, you're trying to build something, you're building a career. What would happen if you got sick or you got injured and you just couldn't work to your full capacity? What would life look like if, let's just say, your income went to zero? And then when clients start thinking about it, they start thinking, well, if my income went to zero, life would be pretty difficult. So what's a way that we can handle that? And the best way to handle that is to protect your income with something called an individual disability insurance plan. It's really, at the end of the day, it's really just that simple. It's just protecting your ability to get up in the morning and work. And we'll make the argument with clients. We give a lot of lectures and we always say to them, what is your most valuable asset? And we'll hear all sorts of different things. People will say, my iPhone or my car, or they'll say like sweet things like, oh, my husband, my wife, my partner, my spouse, my children. And these are all good answers. Our favorite answer of all time.
Someone declared freedom rather loudly during a session.
Freedom, most valuable asset is freedom. And these are all fine, all good answers. We'll make the argument your most valuable asset is your ability to get up in the morning and do what you're all training to do. For every resident, like it's your ability to get up in the morning and earn an income and see patients and help patients and earn an income. And if you couldn't do that, life would be really difficult. And I think that conversation of realizing that your most valuable asset is that maybe shifts the way people think about disability insurance and why it might be so important to have.
And I always tell clients that if you got a dozen planners in a room and you ask them to find consensus on any given financial topic, so the best mutual fund, the best ETF, the best way to structure a mortgage, the best student loan, it'll be very unlikely that you'll find any consensus within the room on those topics. But there's a universal sort of agreement amongst good planners that the first most important thing that you can do is protect the income source that provides for everything else in a person's future.
And I think one way, just listening to the way you describe that, your work and the personal and professional reward that comes from your work, well, that's a great value, that's a great asset. But your work is also the thing that funds paying your mortgage, that helps you save money for your kids, that helps you prepare for retirement. And so really you're safeguarding those processes as well as your ability to do the work that you are trained to do, caring for patients, right?
Yeah, I mean, your income fuels everything. So, when we meet with people, we'll have that conversation about why it's so important. And a lot of times I think financial advisors, you meet with somebody, you meet with a resident either, and they want to talk about investments. And we'll say to them, do you have a lot of money to invest? Well, no, I have no money to invest, but we know we will one day. So we want to talk about investments, or we want to talk about getting ready for retirement, or some of these retirement accounts. We've heard about Roth IRAs and 403Bs, and we know we should be doing that. And can we talk about that? And I think it could be a mistake to plan your whole financial future, and then you're exposed to these things that could happen to you today. And you getting sick or injured and having no income or having a reduced income will drastically change your ability to do any of those things. Even if we're giving these great rates of return, you say, okay, we'll invest this money and we get you this really high rate of return, but then you get sick or you get injured and you can no longer fuel that. You can no longer put money away to investments or savings or anything because there's no income. It's going to really negatively impact your entire career.
I think that's an important segue. Many of the people that are going to be viewing this will be either in jobs or looking and evaluating potential jobs that offer as a benefit group disability insurance. And so I think a justifiable question is that enough? Like, I have that group through my employer. Do I need anything? Why are we talking about this?
Well, Chris always says, and I agree with him, that group disability insurance is better than having no coverage, but it's not much different than having no coverage at all. So especially for medical professionals, with almost every group plan nationwide, the definition of disability, like the specialization language for the person who has the policy, is usually only limited to covering their specialty for 1 to 2 years. And then thereafter, the definition becomes much broader. It becomes an any occupation definition, which means if you can find something that you're reasonably suited to do for a living, the insurance company will help place you in that direction to find work. They'll no longer protect you as an internist or as a surgeon or as an anesthesiologist. That being said, group insurance is almost always a part of someone's disability portfolio because wherever they go to work, at least with larger institutions or middle-sized institutions, they're going to have access to some group plans, and usually they're enrolled in them automatically. So they usually will have some of that coverage as part of their portfolio, but in realistic terms, their private coverage is going to be the core piece of what's protecting their specialty, and the group plans really won't come close in terms of the quality of the coverage.
Yeah, when we meet with clients and we sit down with them and we actually explain, here's the way the individual plans work, and here's the way the group plans work, a lot of them will say to us, can we just not have the group? Can we opt out of the group? And you really can't. A lot of these companies, they'll have the group plan really to protect the company. They want to say, look, we don't want you getting sick or injured and going to us. Here's this group plan for you. If you get sick or injured, there's an insurance company, we're paying for it, you deal with them, and we wish you the best. And unfortunately, for a lot of people, if they don't have these conversations, they don't understand how individual coverage works, they have the chance that if they do get sick or injured, they're going to be left to that device, and they're going to be left to the group plans, and then they'll actually see how difficult it is to actually get paid on those policies and how they actually work. And it's a very different path you take. The individual plan, it's your plan. It's your plan. It goes with you for the rest of your career. It follows you. And it's really important. It's a portable plan. It has discounts that'll be associated with your institution. It's a really great thing to have. Not always easy to get, but it's a great thing to have. The group plan is going to be, well, now you're sick or injured. Who are you? Like, who are you? We'll figure this out. We're going to have our insurance company contact you. You'll deal with them. And that insurance company is going to say, yeah, we don't know who you are, but we have physicians on staff that work with us, and they're going to come out and meet you, and they're going to decide if you're sick or injured, and they're going to look, and you're going to have to deal with the waiting times, which are going to be a lot longer than the individual plans, and you're going to deal with our definitions, which may not put you in a good situation. But remember, this was free. You didn't pay any money for this, or you paid very little, and you're going to get what you're going to get. And I think that's difficult, especially when you're going through that as somebody who didn't know that was an option, didn't know that's what they would be having. Where the individual plan, it's a very different path, and it's really structured towards you. It's structured towards your physician. So if something goes wrong, they're talking to your doctor. It's a completely different process that will be much more in favor for our clients, for the insured.
If I'm in a situation and I'm looking at a couple of different jobs, and they both have group disability plans, can you paint a picture of how my life, my employment would be different if I had my own individual policy? How does that impact my situation if I get sick and can't work?
Yeah, we like to give an example a lot. we live in New York, so we give this New York example. We have 2 different hospitals, and let's just say for a moment, this works, of course, for residents. It's really, we want the residents to think about it right now and why it's so important. But for a moment, let's just imagine you're done with training and you have 2 different job offers. And the first job offer, again, New York City, we're going to go to NYU, which is located at 30th and First in Manhattan. And they're going to offer you, we can use any specialty. We could say, let's say interventional cardiologist, they're going to pay $500,000. Great, nice starting income. And it's going to be a private practice with hospital rights, NYU. And clients thinking about it, and they're looking around, they find another opportunity at 70th and First, which is Cornell. Cornell's like, come work here, private practice, hospital rights. We'd love you to come work here. And they're like, all right, what are you going to pay me? And they say, we're going to pay you $495,000. And the client's like, all right, I got NYU at 30th and First. I have Cornell at 70th and First. I'm looking around, I find this high-rise building, it's at 50th and First. So the commute's the same. We have the Second Avenue line there, commute's exactly the same. And now we're like debating. We got the NYU, we got Cornell, and we tell clients, let's just assume everything else is the same. Let's say the benefits are the same, not a trick question about taxes. We respect NYU and Cornell the same, which may or may not be the case, but everything is the same. Which job would you pick? And a lot of times, at least we hope when we give this example, we hope the clients will say, the first job, NYU. And we'll say, why are you picking NYU? And they'll say, well, it's more money, and that's a good thing. Although sometimes we'll have clients that will say Cornell, and that does concern us a little bit because it's less money. It's not a very good financial start for them. And then we'll say, here's the only variable. There's one variable we're going to throw in the mix here. NYU is going to say the following. They're going to say, if you get sick or you get injured and you can't work here, you can't do your specialty in cardiology, you can't be an interventional cardiologist, it doesn't make us bad people, but you aren't actually able to work here, we're not going to pay you any money. In fact, after 6 months, we're going to let you go. It's a standard contract that's in just about every institution in the country. You're not working here, it doesn't make us bad people, but you're not working, why should we pay you? And that's the first job. And the second job, the Cornell job, the one for $495, says, if you get sick or you get injured and you can't do interventional cardiology, we're going to pay you $144,000 a year. And it's going to be tax-free. And you can do whatever else you want to do. You can make as much money, do whatever else you want to do. We'll keep paying this $144. And every year that you're out, we're going to take the $144 and we're going to compound it by 3% just to keep up with inflation. And if you can come work here at this institution a couple hours a day or a week or a month, we'll give you part of this $144 just to get you back to the $495. We're going to keep on compounding it every year. This will become more and more money, become millions of dollars, tax-free dollars over time at age 65. Which job do you think you'd pick? And I would say every resident that hears that, every physician that hears that goes, well, I would be B, I would take B. And the question I'll always ask them is, well, why? Because B is less money. B is $495, the other one was $500. What's the reasoning? And the reasoning is typically, I'm willing to sacrifice that $5,000 for the assurance that if I do get sick or I do get injured, I'm protecting my ability to get up in the morning and do my job. Like, I'm protecting that income. And now they could still do the things that they needed to do. They could still put money away. They could still hopefully have stuff for retirement. They could have investing. They could do those things, and their entire life is not completely stopped as it would be with the first job. And that really explains how an individual disability insurance plan works. It works in that way.
So that $144,000 is part of your illustration of what the individual disability plan would entail.
Yep, that is kicking in, and that is paying that benefit to them. Now they're sacrificing income. They're making less money. They're saying, I'm going to buy this plan in case I get sick or injured. It's not going to be as much income to me because some of my income is going to be going to have this protection. But now I have that assurance that if something does go wrong, if I get sick or I get injured at any point in my career, I'm going to have this plan. And this plan is going to cover me in a lot of different ways. And then we'll talk about that. That's why I think some of these individual plans are really important, because they have so many features that will help clients in any time during their career. Like, that something can go wrong and this plan can kick in and help them, give them an income.
So based on that illustration now, I'm convinced. So now what's the next step? Let's say, okay, I see the value, specifically I see the value for me in terms of protecting my ability to provide for my family and pay the rent. What are the once someone decides, yes, this would be of a desirable type of protection for me, what are the next steps?
The good news is there's only a few companies that offer the plans. So they can look at everything without it being a long-term search. There's 5 companies typically that people look at, especially medical professionals. They limit it to a search among 5 companies. Simultaneously, the bad news is there used to be quite a few more companies. The ones that still remain in the marketplace are very particular about who they insure. So when you make a decision about which company to choose for your insurance, you have to factor in the provisions of each plan. They're all very similar, but there are some subtle differences that you really want to be mindful of. But you also need to factor in your health history, because health history will play a major role in really which plans you have access to. So you really have to be thinking about my specialty, how the plans differ in terms of the functionality relative to my specialty, and then my health history, because that's going to be one of the biggest determining factors in what you have access to. And since there's only 5 companies left, I then tell clients that the bad news is there's only 5 companies left. So it's not really a buyer's market in the sense that if the insurance companies find you to have previous existing health conditions, they can use that as a mechanism to either not offer you coverage or to offer you coverage with limitations or exclusions, as they call them, for things that they won't cover that previously existed within your world. So in terms of getting started, look at the full field, speak with someone that understands the process of qualifying, and have a frank conversation about your health history to determine which plan makes the most sense for you.
What we find really interesting, I don't know if most people find this interesting, but there are 5 companies now, and as Pete mentioned, they call themselves the Big 5, which is sort of cheesy, but it's true. So they call themselves, and they're all different. So I think people look and go, there's 5 companies that are probably very similar, and I think a lot of people now, they go online, they try to find, they get spreadsheets, and we're not really big fans of that, because all 5 of those companies are different. They all have different benefits. They have some of the same core things, but there's some different ancillary benefits. They have different rules, depending on if you're going to leave the country, stay in the country, if you're out totally, if you're out partially. And what's really interesting is that you want to go through those areas and you want to make sure and say, this is my specialty. Let me go through this contract in full from top to bottom and decide which one of these plans makes the most sense for me, because they are all different. And I think that's really important. Sometimes people, I think, will look and they'll say, well, these all are pretty much the same. I'll pick the one that's the cheapest. And often that plan is maybe a little cheaper for a reason. Maybe it's lacking in something that might be really important to that client. So I think a good advisor's job is to say, this is your specialty, let's go through these plans and see which one makes the most sense for what you're trying to accomplish. And I think that you'll find that they are different. They're not exactly equal, but they're all good because they're part of that Big 5.
Let's say I'm in a specialty that relies heavily on my vision. Radiologist, dermatologist. What you're saying is that, well, there are some policies that would be better for me or would require me to get an extra rider, an extra part of the policy to make sure that loss of vision is covered. Am I understanding that right?
I think all the Big 5 will be great for that. If you have a loss of vision, you can't do your job, all those Big 5 will be perfect. I think it becomes more depending on what that particular person wants to accomplish in their field. So for instance, if somebody said, I plan to have my own private practice one day. That's really important to me. They may want to look at something called the recovery benefit, and how every plan has a recovery benefit. They differ depending on the company. So somebody may say, I have my own practice. You're a dermatologist and you're doing really well. You're a great dermatologist, you have a great practice, everybody's going to you, but then you get sick or you get injured. And maybe I quit my job, maybe I'm working with you, I'm your number 1 assistant. And you call me one morning, you're like, I'm not getting into the office. And I said, well, it's just you. What do you mean? You're like, I'm not feeling well. I'll let you know when I'm back. And let's say 3 years go by. I mean, I'm not doing well. I have no money. You're not around. But all your patients are going, where's Dom? Like, what is going on here? And what will eventually happen is they'll end up leaving. Now, you're sick or injured, you're going to get paid by all those insurance companies. There's going to come a day, maybe you wake up, you're no longer sick, you're no longer injured, you feel perfect. You go to work, I'm sitting there going, what the heck is going on? And you're like, I'm back. Send in my first patient. I'm going to say to you, Dom, there's nobody. There's nobody left. You were out for 3 years. They've all gone to other dermatologists. You're a big deal, but there were other people that needed to get figured out. This is where these contracts are going to matter. Some of these plans are going to say, well, we'll pay you for 12 months. Get back on your feet. We'll give you a benefit for 12 months. We'll help you rebuild your practice. Get 12 months. If you need more than 12 months, we're not going to pay you anymore. They'll give you a benefit, even though now you're totally healthy, because you lost those patients and you lost income because patients have gone somewhere else. They'll give you a benefit for up to 12 months. Some of these contracts will give you a benefit until you're 65 years old. Some of these contracts will give you a benefit until you're 65 years old and your income is within 20% of where it was before you got sick or injured. And some of these companies will give you a benefit until your income is within 15% of where it was before you were sick or injured. And that 15 to 20% is a big deal. So now we looked at like 3 different things. We have one company that's saying you got 12 months and then we're done. We're walking away from you. We have another company that says we're going to cover you all the way to age 65 and until income's 20%, and one 15%. And let's say you're making 300 grand a year and you lose 18% of your income. Like 18% of your income now is drop, let's just say. Well, that one company that was going to wait till 20, this is a different benefit. They may say, you didn't hit the 20, you only hit 18. We can't pay you any money. Where the company that was going to be 15% is going to say, we're going to give you a large benefit amount because you triggered our benefit. I think that these types of things, they're the conversations you want to have with your client before the incident actually happens. So you want to say, here, you have this practice, let's look at these plans and how they differ. And then they can make an educated decision on which plan's right for them. Like Pete and I will never say, this is the plan you got to do. Pete and I will say, here are probably the plans you want to look at. Here's probably your most comprehensive plan. Here's probably your least expensive plan. Here's probably your plan somewhere in between. Let's look at all the discounts involved. And let's figure out which plan is the right plan for you.
Another great example is if someone's doing procedures. So if you have a doctor who's, repairing knees for a living, he's doing a lot of ACLs. All 5 companies have specialty language in their contracts that say that if you can't practice your medical specialty, we'll consider you fully disabled, we'll pay the full claim, even if you can go out in the world, be in contribution, make money doing something else for a living. But some of the companies actually will also include procedural language that says, if 50% or more of your income is coming from surgical procedures, they'll consider you fully disabled if you're no longer able to bill for those specific procedures. So if you're a doctor, say you have a private shop or a small shop and you day in and day out are billing for ACLs, that makes up 75% of your income. Let's say you own a surgical center, you're part of it's a practice, you're a partner, you can't do that procedure anymore. With some of the companies, you can stay on in your practice, do the consults, maybe pivot to less labor-intensive surgeries, just kind of get away from ACLs because you can't really do it anymore. And that'll be a full claim, even if you're making hundreds of thousands of dollars staying within the practice and doing other things, because the insurance company is tethering what triggers the disability claim to the procedures that you were doing at the time that you got hurt or sick.
Other companies would say, well, wait a second. We're not going to pay you because you're still in your field. You're not really totally out, you're only partially out, so we'll give you a partial benefit. Now you have those are 2 different ways they're going to pay that, and that's going to put 2 different amounts into the client's pocket. And the client should know that before. Here's what would happen, here's how you'd be paid, and then they could decide like which plan is the right plan for me. And I think part of our job is just, and this is for every advisor, I think it's making sure the clients know their options.
There's no way I would feel confident navigating the nuance that you just described on my own. So and I like to do things on my own. How do I access the big 5 and how do I make this comparison? I wish I had someone to give me advice.
You have to go through an advisor. You can't actually buy an individual disability insurance plan by yourself. So for instance, let's say you said, I did my research, Principal is the company for me. I like Principal. And you look it up and you do it yourself and you go, Principal is in Iowa. You get in the car, you drive to Iowa, you go in their office, and you say, I want this plan. They would say, it's nice to meet you, but you have to go through a registered representative. We can't offer you this plan. So an advisor will be able to place that plan with that company. But really what that advisor is meant to do is to show you the options. Then you could decide which company is the right company. That advisor can place that business with the company. You end up spending time with Principal. Principal is your company. The advisor is the one who introduces you and explains the way that plan works.
Yeah, and there's been a rise in online portals to access quotes for disability coverage. And from those portals, you can then, with relative ease, apply for coverage. There's still an advisor involved, but they've just kind of taken a back roll to the automation of the website. That's a reasonable way to get quotes, but I wouldn't recommend that people go through a portal like that where they don't have a conversation with an advisor before making an application. Because as I mentioned before, your health is such an important part of the decision about which company to try to align with, that going through a portal, not having a frank conversation about your health history can put you or about the subtleties and the differences in your specialty versus others, could put you in a plan that you're only choosing because on a spreadsheet online, it seems to be the cheapest option. And with insurance, it's always a function that you get what you pay for. So if anyone is showing a disability policy for what appears to be the lowest price out there, It's just that things are missing from the coverage. It's not that there's some special arrangement between broker A and principal where they get a better deal, but rather there's something not right about that quote. There's something missing that might be really relevant to their career, to their specialty.
I think more and more advisors will hopefully feel this way. We're not big fans of the spreadsheets. So a lot of times what will happen is if you're somebody, let's say you go online, you'll get a spreadsheet sent over to you. And that spreadsheet will have some numbers on there, will have some check marks, but those check marks should really have a story behind it. Like if you look up, for instance, residual. So residual just means you don't have to be totally out to get something. So you work a couple hours a day or a week or a month, that's a residual benefit. It's most claims. Most claims are residual. So most claims are not somebody saying, I can't do anything. Most claims are saying, I can still work, but I can't work to the capacity I was working before I got sick or injured. So I'm gonna be on a residual claim. If you were looking at a spreadsheet, you may see 5 companies in that spreadsheet, and you may see they all have residual checked off. And you may then think, all right, these are all residual. These are great. I'll probably pick the one that's the least expensive because they're all the same. A good advisor will go over and maybe not even show you that spreadsheet. Maybe they'll do some of the narrowing down for you, but they'll say to you, all 5 of these companies have residual, but they're all different. And we should go over the differences and see how that pertains to you and your specialty. I think that's a really important thing that sometimes gets lost. The client should understand that. And I mean, these conversations, it might take 30 minutes, 40 minutes, an hour to go over it, but when you buy disability insurance, you're making a decision about what your life is gonna look like at a very low moment. So you wanna do all that stuff up front. It'll be much easier for you later on if things go not perfect.
I've met with an advisor. I've purchased an individual disability plan, and let's say I'm in residency. Well, I'm now gonna go to fellowship. I'm then gonna get a job as an attending. Life is gonna go on. What happens to that policy as life goes on?
So the recommendation that we have for all especially the trainees, is to get a small amount of coverage while they're in training. Like pick a company, align with the company, get through the qualification process and have a starting sort of benefit. But the most important provision, it varies by company, but a mechanism by which they can always increase the coverage in the future without any medical questions being asked at the time of the increase. So essentially you could start with a $4,000 or a $5,000 a month benefit, get through your training, get through your fellowship, transition to an attending role, and then from there, you can ask the insurance company to increase your benefits even if health has radically changed. And they have to honor the agreement, they have to increase your coverage, and any of those new conditions are all covered by the original policy. So in terms of sort of the way that a disability policy moves through time is you lock in something while you're in training, you really don't do much to it until you become an attending, and then you make a decision on to what extent do I want to increase my coverage. When you go to increase it, one of the nice benefits is that also all of the rates and the discounts that came from your program where you acquired the coverage are attached to any new coverage that you purchase when you go to increase the coverage too. And that's really sort of like the custodial work, and that's something that your advisor should be a part of to say, like when we talk to any new resident, we say, when are you graduating? We put it on our calendar, we make a note to do as good as we can to check in with them at the point that they'll be making the transition, to have the conversation about scaling the benefits up. The other thing that's really good to know is that all the plans are what's called guaranteed renewable and non-cancelable. It sounds kind of like imposing language, but it really just means the insurance company can never raise the rates on the insured and they can never cancel on the insured. So I always tell clients that unlike auto insurance, where if you have a couple of fender benders, if your rates aren't going to go up, they're just going to cancel you outright. With disability insurance, if you're very unlucky and you use the plan a dozen times, the insurance company can never change the rates on you or cancel on you. So you're really in complete control. The only thing that you have to do through time is make the determination of where is my income at relative to my benefits, and should I be scaling the benefits up to a larger amount? And you're in complete control for that. The insurance company can't take that away from you. But it has to be something that you have as part of the initial policy when you get it.
So if I understand it, if I, as a resident, purchase an individual disability policy, and the premium is $100 a month, 20 years from now, I'm an attending, is my premium still going to be $100 a month, even though I've increased the coverage?
For that first amount of coverage that you bought, let's say it was, as Pete mentioned, $4,000 a month, you paid $100, and it's a level premium. That $100 will be $100 moving on. It will not change for the $100. When you go to buy more coverage, this is with all 5 of the companies, when you go to buy more coverage, you're going to get all the discounts on that additional plan, the discounts that you originally got at your institution, and you'll be paying more because you're buying more coverage, and your health's going to be locked in with all 5 companies, but because you're older, the price will go up. So it's going to be more than it would be if you bought it, let's say, a year ago or 2 years ago. Every year you get older, disability insurance gets a little bit more expensive, which is another reason why we recommend, there's a couple reasons why you want to get it as young as you could possibly be. Cost is one of them. Like the younger you get it, the better. Like it's going to cost you less money over time to buy it at a younger age. The other idea is it locks in your health. Like you want to get this because disability insurance is hard. If you're going through what's called regular underwriting just means take a look at my entire medical history. You could use it against me. And the insurance company, they'll use it against you. Like they'll say, okay, game on, we will use it against you. And they'll look for things to not cover you. So if you can be young and healthy as possible and get that coverage through regular underwriting, you lock in your insurability for the rest of your career. When you buy more coverage, though, you buy that additional coverage at whatever age you are, but the discounts will still be on there. So if you doubled your plan, if you had, let's say, 4,000 and then you wanted 8,000, but it was 2 years later, that additional 4,000 is going to cost a little bit more than the first 4,000 because you're going to be older.
Yeah, I always tell clients that if you get your first 4,000 as, say, a 28-year-old, and then 3 years later you become an attending, so you're 31, at that point you want another 4,000, what you start to see on your bill is 4,000 purchased at age 28, $100, 4,000 purchased at 31, $115. But throughout the course of someone's career, what they end up having is maybe 4 or 5 iterations of coverage because there were 4 or 5 times in their career that they decided to scale the benefits up. You have that initial tranche as a 28-year-old, a piece as a 31-year-old, 35, so on and so forth. So as Chris had mentioned, like the best laid plan is to get a good chunk of coverage early, and then as you become an attending, to do another meaningful increase to make sure you're locking in pieces of coverage at the lowest possible age points. You don't want to get the attending amount, or the resident amount rather, say $4,000, lose touch with your advisor for 15 years, and then as a 45-year-old with considerable expenses, mortgages, school, all those sorts of things, be like, holy cow, 4,000 is insufficient. I need to go up to 20,000 because that additional 16 that you'd be adding is going to be as a 45-year-old. All the discounts, like Chris said, would carry forward on that increase, but your age is the only thing that's floating through time until you use it.
How do I know how much disability benefit to get?
To start with, as a
Or
resident?
to start with, or even as an attending to go up to, what are the benchmarks that I'm trying to, should I try to recover my entire salary or a percentage thereof?
No insurance company will let you cover your exact income when you're done with training. Because if they did, people will be just running into walls. They'd be like, I'm injured, I can't do any work. So they'll give you a percentage. Typically it's about 60%. There's ways, some companies will get a little bit more than that. But what we always tell clients, we apply for the max. When you're done with training, we look and say, here's how much you could possibly have. Here's the most the insurance company will give you. What do you think? And some clients will say, yeah, I want to get as much coverage as I can. And ideally, that's the conversation we'll have a lot because you're now done with training. We know your income is really important. We know all these things are going on now. Now we're saving, now we're investing, now we're doing all this planning. We want to make sure that if you get sick or injured and something goes wrong, none of that's going to stop. So we'll go over that with them and we'll say, here's the most you can get. And a client will typically pick a number between what they have and the most they're able to get. And our job is just to go over those options.
Yeah, I would say the goalposts are the full amount that you can acquire, which is what we always advocate for. And the other side of the spectrum would be enough to cover all of your monthly expenses. And very few clients, very few physicians actually go with that lower amount. They typically go with something much higher. Because as Chris has mentioned, I always tell clients that first year as an attending, I mean, I hate to fly, so I use this as an example, that first year as an attending, in those first couple years, it's like takeoff on a plane. It's the riskiest part of this experience. Like, if for any reason you don't get off the ground, as a physician, that means there were 30 or so years where you weren't able to earn 3 or 4 or 5, whatever that number was that you were going to earn for that career. Now, if you get hurt or sick at 60, you had 20 or 30 years in the rear view where you were able to earn and save all that money. So the exposure is lower farther down the road. But early in your career is a time when you really want to maximally protect yourself because it's much more significant, the financial impact if something happens early in the career. Once someone becomes an attending, we look at what they'll be making, what their other sources of disability coverage are, and we advocate for them to sort of maximally protect themselves.
5 companies are left. That means there were more companies before there were 5. Why did all those other companies drop out, and are physicians in a special category in terms of their need for or use of disability insurance?
A lot of companies just left the field. So a good example would be, I'll say a company. A good example, when we first started, there's a company called MetLife. MetLife is Snoopy. MetLife was a company, they had really great pricing for a lot of different specialties, especially general surgeons. And MetLife eventually, they had a lot of clients on the book, they did very well. but they weren't making the amount of money that they were going to make off disability insurance. So MetLife basically said, we're kind of out here. Like, if you have a plan with us, sure, but we're kind of out. And what they did is they sold that entire book to MassMutual. So MassMutual took all those people on. MassMutual is one of the big five and should be considered. And I think that does happen a lot. But what's really important is all five of those companies basically say, we want to make sure that our policyholders know they're protected. Because what you don't want to have happen is you don't want to be with a company and that company goes out of business and you go, oh my God, I'm in a lot of trouble, what do I do? You want to know that no matter what happens, somebody's going to come in and take over that policy. And that's what's happened for many, many years. We see that with another company, Ohio National, which was really popular a couple of years ago. Not anymore. Now they're gone out of the business. And those policies get bought by other companies, and they're still in business, and they keep the original policy language on that contract. Because as Pete mentioned before, they are guaranteed renewable, non-cancelable. So that's a really important thing. When you get that plan, you know that you're going to be okay for the rest of your career because of that policy language. And you know that if something goes wrong, someone will pick that plan up.
And actually, we have surgeons that have policies where the provider is no longer in the business, but they still get their statements from that company and they still have their increase options ostensibly from that company. So the contract doesn't change, and people that are on the books with those companies aren't in some way out of luck.
Well, going back to something you said before, Pete. So let's say that my situation is that I have a mental health condition and I'm taking medications for it, and I'm a resident. And now I've heard your talk, and I say, well, I want to get disability insurance now because it's going to be less expensive. What challenges am I facing as someone with a pre-existing medical condition?
It's a great question. It's actually one of the most important things to figure out before you try to apply for coverage. So in that example with a mental health medication and maybe say one diagnostic code for a mental health issue and a stable medication. Compliant patient, you see another doctor, you don't self-prescribe, and you've been good and stable with the medication. There haven't been a lot of differences, and there's only maybe one diagnostic code associated with it. That's not going to disqualify you from accessing coverage. Most of the insurance companies would say you're eligible, but we're not going to cover mental health. So you'd be approved with an exclusion for mental health. Where people get into a little bit more trouble, though, is if the mental health diagnoses are multiple, and oftentimes it is, an adjustment and a depressant. There's a lot of different combinations that you might see in your chart associated with the medications that you have. Simultaneously, not being a compliant patient. We have clients that say, you know what, I was seeing a therapist and I was on a medication for a couple of years, but good news, I titrated off the medication. Well, it's like, well, did you do that with a doctor's blessing? Did somebody actually walk you through that? It was your own thing. Like instances where you're not necessarily following the guidelines, or like I said, you're self-prescribing. If you're not a compliant patient in that space, it can be more problematic. Or if there's multiple diagnostic codes and multiple medications involved, there are instances where that mental health concern might be a deal breaker to acquire coverage at all through the conventional channels, like through the fully underwritten coverage.
So these benefits, do they go for the rest of my life?
Typically they go to for most companies, they go to age 65, or age 67, or age 70, depending on how you structure the policy. I think a lot of people pick age 65. And after that, a lot of the plans become conditionally renewable, which just means you can keep the coverage. The benefit period becomes a typically 1 to 2 year benefit period, and you have to prove that you're working a certain amount of hours per week. And if you can do that, you can keep that plan going. A lot of these we have clients that now they're much older and they're keeping their policies, and they'll do that until they want to stop working. I think one really important thing is a lot of times we'll meet with clients and this is both of us close to 20 years, and we'll meet with clients that are now in their 50s and they're saying, look, I have my disability insurance, it's great, but now I have all these assets. I built up assets. Residency was so many years ago. If we got sick or injured, we have all these assets. So I don't even know if we need disability insurance. Should we honestly keep this, or should we just get rid of it? That's a really common conversation we have. And ultimately, clients will keep it. And they'll keep it because when they realize that the disability insurance is there, it was there to protect income, but eventually it'll be there to protect assets. So the conversation we'll have is, what are all those assets for? And clients will say, well, the assets are for our kids' education or for our retirement. And we'll say, well, if you get sick or injured, do you want to touch those assets? Or do you want to let them grow so they could be the largest number possible when you head off to retirement? And they'll say, well, I probably want to let those grow. The concern would be if you didn't have disability insurance and you weren't sacrificing 1 to 2% of your income, you end up touching money from those assets that were going to grow for another 10, 15 years. Now that number can't grow. that small amount that you pulled out could cost you thousands and thousands of dollars. So a lot of clients will keep it until they retire. And they'll sometimes say, what if I never get sick or injured? And we'll say, well, that's pretty good. That's a good thing.
Scenario, really.
Yeah, that's
truly.
the move. We'd be happy to hear that. I mean, we want clients, yes, you sacrifice some of your income for this, but if you never get sick or injured, it means you lived a good life. You didn't get sick or injured, you didn't need this. But it's a much better plan when we know that if something does go wrong, this is in place. It's just one less thing for us to worry about.
And it's typically 1.5% to 3% of someone's income is the cost associated with protecting that income. So what I usually tell clients is, say it costs 3% to cover your disability coverage to get you to retirement, but that insulates your income going forward. We know that it's going to be all realized if anything happens. That means you have a 100% chance to get to 97% of your wealth building sort of output, because you had to put 3% towards protecting it. Alternatively, nationwide, you have a 1 in 4% chance of becoming disabled before age 65. So would you rather go with a 100% chance to get to 97% of your wealth output, or a 75% chance to get to 100% of your wealth output? Because you didn't pay for the insurance, right? So, and you didn't get disabled. That's your, very few people go with that second option because it doesn't make any sense, So.
That's a valid way to look at it. So one other question. We're going to do a separate module associated with the disability section of this curriculum on GSI. But I think it would be helpful if you could describe GSI and what it means so that people watching us now can determine whether or not they want to go and learn more about it.
So GSI stands for Guaranteed Standard Issue. It's a means to acquire disability coverage with one of the 5 carriers that are out there without medical questions being asked. It's typically available as a function of where someone is in training. Not all institutions have it, but some do. So if someone has health history that's meaningful and it could preclude them from accessing coverage through conventional means, that full underwriting process that Chris mentioned, if they can find and have access to a GSI plan, it's a mechanism to get an own occupation disability policy without having to answer any medical questions. It does have some limitations relative to a fully underwritten version of coverage, but in some circumstances that doesn't matter, because if someone's not insurable because of health history, if the GSI is available to them, that could be an absolute lifesaver, a way to access coverage even if they have significant health history.
And so from what you said, it sounds like GSI related disability policies are tied to particular institutions.
Yeah, that's correct.
And how would you, before someone takes a look at the GSI module in this part of the curriculum, how would they find out if it's relevant to their training situation, if their institution provides that?
I think realistically, it wouldn't be something that they can necessarily find through like an online portal. So if they go to, I won't name names, but if they go to an online portal and try to find disability and say, type in your school, it isn't obvious that they're going to find whether or not there's a GSI there. Typically, it's in their best interest to find an advisor that's local to the school or that is aware of GSIs nationally that could help them determine if that's something that's available to them.
If there is a GSI, they'll be getting 500 million emails a week. So advisors, even if they don't have access to the GSI, they will send a lot of emails and they'll try to get access. Eventually they'll talk to other advisors who may have access to the GSI. They'll ask if they could use the GSI, and these things will happen. But I think if there is a GSI available at the institution, it is always worth looking at, and there are some rules around it. So you'd want to look at the GSI before looking at any other company. One of the rules of every GSI is that if you go somewhere else and you apply, and even if you don't get a perfect approval or you get denied, you may not be able to get that GSI. That GSI may be off the table for you. So it's important that you just do things in the correct order, where looking at the GSI would be the first thing you'd want to do. And you'd really want to look at the GSI if there were health concerns, or if there was something in your background that could be considered concerning to the insurance company. So when you apply for coverage, you almost want to think, a lot of times clients think, well, I don't really have any health concerns. I got nothing in my background is really there. But the insurance company may look at that very differently. So a client may say, the only thing I had a knee surgery like 7 years ago. My knee's fine though. I had some hardware in there, but there's no issues. The insurance company will find that to be an issue, and they'll likely not cover your knee. The GSI plan will cover your knee. So all of a sudden you have a client going, wait, I can get my knee covered with the GSI plan? That's probably the right avenue.
Also lifestyle stuff. So someone could be completely healthy, but if they're a spelunker or an aggressive rock climber or martial artist, any of those sorts of things, they can be a problem for a conventionally underwritten policy. GSI plans will not penalize you if you hike Everest or if you cave dive or whatever people do.
Okay, so if anyone is interested in GSI programs, we're going to have a separate section within this portion of the curriculum dealing with that specifically. For this general section, is there anything that we haven't talked about that we should regarding disability insurance?
I think it's important too. I think sometimes people look at the cost and they go, oh my God, can I afford this? You don't have to buy the largest amount of coverage. Like we'll sometimes see that. We'll get a phone call, we'll get introduced to somebody and we'll say, why do you have so much coverage? If you got sick or injured, this is more than what you're earning right now. You don't need to do that. I think you just want to get a number that will cover you right now. So for a lot of our clients, it's $4,000 a month, it's $3,500 a month. It keeps your costs a lot lower and you still have the option to get a lot more in the future. And I think when clients know and go, oh, I could pay under $100 a month and have this, that sounds good. It doesn't have to be $300, $200. It could be under $100 when we're able to structure it and go through your options.
Are those advisors always local?
A lot of advisors will not be local. They will typically have good traction at that institution, meaning they'll be working with a good amount of residents and fellows and even attendings at that institution. That's one thing you'll find.
I think of working with an advisor as someone I can go see. Is there any risk if I have an advisor for, say, this particular role or any financial advisor, if that person is geographically distant from where I am?
In my 20 years, I've had one or two clients that have said, I want to be able to go down the street and have a conversation face to face. If that's not your personal predilection, you certainly could work with an advisor that has sort of a national reach. Chris and I are licensed in all 50 states. The reality of it is, we work with a lot of the residents at Brown. A lot of them actually stay in Providence because it's such a nice place, but a lot of them go elsewhere too. So they end up all over the country, and our goal is to work with them wherever they are, absent of them wanting to work with a local provider. But it's very seldom the case that that's something that people are interested in. A
lot of clients will be here for residency and they'll say, I love it here. I may even stay here for fellowship, but home is California, home is Texas, home is somewhere else. And yeah, with today's technology, it's amazing. A lot of clients, we offer Zoom, but a lot of clients just want to do phone calls. We have Zoom calls are great. I think anything that gets us in front of clients is wonderful, but I think it's really, really common now where you'll have an advisor working with a client, and that client could be anywhere in the country or really anywhere in the world.
Well, thank you very much. That was really, really helpful.
Thanks for having us.
Sure, thanks for having us.
Yeah.